Hey everyone, welcome back to the channel. Today we're tackling a question I get constantly. How do you actually win at Forex algo trading? Not just how to build algorithms, but how to make them consistently profitable in the real world. Let's be honest, many algo traders fail not because their ideas are bad, but because they miss critical implementation details. By the end of this video, you'll understand the key principles, tools, and risk management approaches needed to succeed. First, let's talk about what Forex algorithmic trading actually is. At its core, it's using computer programs to execute trades based on predefined rules and strategies. These algorithms analyze market data, identify opportunities, and execute trades automatically, often much faster than human traders ever could. In fact, by 2024, approximately 92% of Forex trading was performed by algorithms rather than humans. That statistic alone tells you why understanding this space is critical for any serious trader. Now, winning in Forex algo trading doesn't mean finding some secret holy grail algorithm. It's about developing a systematic approach that combines robust strategy design, rigorous testing, and prudent risk management. The traders who succeed are those who understand both the technical aspects and the market mechanics. Let me walk you through the key components you need to master. First is strategy development. The most successful retail algo strategies typically fall into three categories: momentum trading, mean reversion, and statistical arbitrage. Momentum strategies operate on the premise that prices will continue moving in their current direction. You might use indicators like moving averages to define trend direction and then take entries when the RSI crosses below 30 in an upward trend. Mean reversion strategies, on the other hand, assume that prices will eventually revert to their historical mean. These strategies look for overbought or oversold conditions using indicators like RSI or stochastic oscillator. Finally, statistical arbitrage, often implemented through pairs trading, involves simultaneously trading two correlated currency pairs when their price relationship deviates from its historical norm. Once you have a strategy idea, you need to implement it properly. This is where tools like StrategyQuant X. Let me show you how you might approach. For StrategyQuant X, your workflow would look something like this. First, you'd define your strategy logic using the Visual Strategy Designer or code blocks. Then, you'd configure your backtest settings including historical data range, currency pairs, and timeframes. Next, you'd run genetic optimization to find the best parameter combinations. But crucially, and this is where many traders fail, you must then apply robust testing methods like walk-forward analysis to ensure your strategy holds up across different market conditions. StrategyQuant is particularly valuable because it helps you avoid overfitting through its built-in robustness checks. Now, regardless of which platform you use, your implementation plan should follow these critical steps. First, data selection and preparation. You need high-quality historical data that includes various market conditions: trending, ranging, volatile, and calm periods. Don't just use a single currency pair or time frame. Aim for at least 2-3 years of historical data across multiple pairs. Second, rigorous backtesting. This isn't just running your strategy on historical data once. You need to apply proper walk-forward analysis where you optimize parameters on a historical segment, then test on out-of-sample data, then roll forward and repeat. This helps ensure your strategy isn't overfit to specific past conditions. Third, forward testing on demo accounts. Before going live, run your algorithm in real-time market conditions with a demo account for at least 4-6 weeks. This helps you identify issues with execution latency, slippage, and other real-world factors that don't appear in historical backtests. Fourth, careful live implementation. Start with small position sizes and closely monitor performance. Have a predefined shutdown rule: if the strategy draws down beyond a certain percentage, pause and reevaluate. Speaking of drawdowns, let's talk about risks and limitations. Algorithmic trading isn't a guaranteed path to riches. It comes with significant risks that you must understand and manage. The biggest risk is overfitting, creating a strategy that works beautifully on historical data but fails miserably in live markets. You can mitigate this by keeping strategies simple, testing on out-of-sample data, and using robustness checks like Monte Carlo simulation. Model risk is another critical concern, the assumption that your strategy will continue working in future market conditions. Markets evolve, and strategies that worked yesterday may fail tomorrow. Regular monitoring and periodic reoptimization are essential, but be careful not to over-optimize. Data issues like survivorship bias can trick you into thinking your strategy works better than it does. If you only test on current currency pairs without including those that may have been delisted or merged, you're getting an incomplete picture. Transaction costs including spreads, commissions, and slippage can completely erase profits from seemingly successful strategies. Always test with realistic cost assumptions. For Forex markets, account for wider spreads during volatile periods and news events. Technical failures are perhaps the most underestimated risk. Network connectivity issues, platform crashes, or data feed problems can ruin your trading day. Use a reliable Forex VPS to minimize latency and ensure uptime. Have backup systems and monitoring in place. Perhaps most importantly, psychological challenges remain even with algorithmic trading. The temptation to override your system during drawdowns or to become overconfident during winning streaks can undermine your approach. Stick to your predefined rules. So how do you actually win? Based on my research and experience, successful Forex algo traders share these characteristics. They diversify across multiple strategies and timeframes. They don't rely on a single algorithm. They manage risk rigorously, never risking more than 1–2% of their capital on any single trade. They continuously learn and adapt as markets change. They keep detailed records of performance, including which strategies work in which market conditions. And they maintain realistic expectations. Consistent profitability is the goal, not overnight riches. Remember, algorithmic trading is a tool, not a magic wand. It requires the same discipline, risk management, and market understanding as discretionary trading, just with the added dimension of technical expertise. Concrete examples and how-tos. Let me give you a specific example of how you might develop and test a strategy using each of the 3 platforms we discussed earlier. For StrategyQuant X, after defining your strategy logic, you would use the built-in genetic optimizer to find optimal parameters. But the key step that many miss is the robustness testing. You need to run multiple tests including Monte Carlo simulations, walk-forward optimization, and out-of-sample testing. StrategyQuant provides these tools. Use them. The software also includes a strategy lab, where you can test how strategies would perform under different market conditions, including sudden volatility spikes or trend changes. Regardless of platform, your performance reporting should include these key metrics. Profit factor, aim for at least 1.5, recovery factor, how quickly you recover from drawdowns, Sharpe ratio, risk-adjusted returns, maximum drawdown, keep it below 20%, and number of trades. Enough for statistical significance but not so many that transaction costs kill you. Actionable implementation plan. Based on my research, here's your step-by-step plan to implement a winning Forex algo trading approach. First, educate yourself thoroughly. Read both the theoretical foundations like Ernest Chan's Algorithmic Trading, and practical guides like Brett Steenbarger's The Psychology of Trading. Understand both the technical aspects and the psychological challenges. Second, start simple. Begin with a straightforward strategy like a trend-following system using moving averages or a mean reversion strategy using RSI. Don't try to implement a complex machine learning system right away. Third, acquire quality data. Use reputable sources for your historical data. For Forex, sources like HIST data offer free TIG data, while paid services like Backtest Market provide higher quality clean data. Ensure your data includes various market conditions. Fourth, develop and test rigorously. Follow a structured backtesting process. In sample optimization, out-of-sample testing, walk-forward analysis, and finally demo trading. Never skip steps to save time. Fifth, implement risk management from day one. Decide your position sizing methodology. I recommend fixed fractional or volatility adjusted sizing, set your maximum drawdown limits, and have a plan for when to stop a strategy. Sixth, deploy carefully. Start with small capital, monitor closely, and gradually increase allocation as the strategy proves itself. Use a VPS for consistent execution and uptime. Finally, review and adapt continuously. Keep a detailed trading journal of your algorithm's performance. Regularly review whether it's performing as expected, and be prepared to make adjustments or retire the strategy if market conditions change. Most load-bearing claims with supporting sources claim 92% of Forex trading is algorithmic support. AccuWeb Hosting's Forex Algorithmic Trading Guide based on 2024 data claim. Momentum, mean reversion, and statistical arbitrage are the most robust strategies for retail traders support. StrategyQuant's comprehensive testing of algorithmic strategies claim. Overfitting is the most common reason for strategy failure support. Multiple sources including Axie Forex's risks discussion and StrategyQuant's backtesting guide claim. Walk-forward analysis and robustness testing are essential for reliable strategies support. StrategyQuant's detailed backtesting methodology claim. Emotional discipline remains crucial even with algorithmic trading support. OpexFlow's review of trading psychology books. Remember, success in Forex algo trading comes from combining robust strategy development, rigorous testing, prudent risk management, and psychological discipline. There are no shortcuts, but with the systematic approach I've outlined today, you're well on your way to building algorithms that can stand the test of time and market variability. If you found this video helpful, give it a thumbs up and subscribe for more content on algorithmic trading. Share your own experiences with Forex algo trading in the comments below. What strategies have worked for you, and what challenges have you faced? Until next time, trade safe.